Problem says that H Limited acquired 4,000 equity shares of S Limited on 1/1/2015. So the date of acquisition is 1/1/2015, and this H Limited has acquired 4,000 equity shares. So now if you look from the share capital, that is the share of S Limited, the total number of shares that this S Limited has is 5,000. So out of this 5,000, 4,000 shares has been acquired by H Limited on 1/1/2015, and the remaining 1,000 shares belongs to the minority holders. Then after that, if you look at the reserve and surplus, the general reserve on 1/1/2015 of S Limited is 20,000, and also they have given you the profit and loss account that is as at 31st December 2015, that is for rupees 25,000. So now in this case, this general reserve and profit and loss account will have to be used in control chart A for the calculation of the capital profit, that is the pre-acquisition profit, and the revenue profit, that is the post-acquisition profit. So remember, in the pre-acquisition profit or the capital profit, we have to take the reserve and profit and loss account as on the date of acquisition. Remember, the date of acquisition is 1/1/2015. Then we'll see later on how that has to be done. Now let us look at additional information. If you look at the additional information, it says that on 1/1/2015, the profit and loss account of S Limited showed a credit balance of rupees 10,000. So that this is the balance of profit as on 1/1/2015 for rupees 10,000. So since this is the profit and loss account of S Limited on the date of acquisition, this will be the capital profit. Then it also says that on the same day, the plant and furniture of S Limited were revalued at 60,000 and 8,000 respectively. So it means that on the date of acquisition, that is on 1/1/2015, the plant and furniture of S Limited were revalued at rupees 60,000 and 8,000 respectively. So in this case, we have to find out whether the value of plant and furniture increase or decrease. Then the next part of the adjustment, it says that these were not incorporated in the books, so and depreciation is charged on plant at the rate of 20% per annum and furniture at the rate of 10% per annum. So remember, the changes, that is the revalue of these two assets, has not been incorporated in the books, and these two assets, that is plant, is charged depreciation at 20% per annum and furniture at the rate of 10% per annum. So the revaluation of assets has been given. Then first of all, we have to find out how much is the increase or decrease in the value of assets. Then after that, we have to see if there's an increase in the value of assets, then we have to charge additional depreciation, and then there's a decrease in the value of assets, then we have to calculate the excess depreciation charge on that particular assets, and then it has to be adjusted accordingly in the profit and loss account. So now let us look at the working notes of how these are to be. So the first one is the degree of control. So the total number of shares of S Limited is 5,000 shares. Then the number of shares which has been acquired by H Limited is 4,000 shares. So the minority shareholders shares will be 1,000 shares. So therefore, the degree of proportionate holding between H Limited and S Limited will be 4:1. That is 4,000 shares is to 1,000 shares. Now, if you look at the second working note, it says calculation of book value of plant and furniture of S Limited as on the date of acquisition, that is 1/1/2015. So if you look from the problem, the value of plant and furniture has been revalued on the date of acquisition. So what we need to do, we have to find out the book value as on the date of acquisition, because we have to find out the increase or decrease in the value of these two assets. So now if you look at the working note, it says book value of plant on 31st 12,015 is rupees 40,000. So remember, this 40,000 is after charging depreciation of 20%. So we need to find the value before charging depreciation. So to find the book value of plant as on the date of acquisition, that is before charging depreciation at the beginning of the year, there will be 40,000 into 100 divided by 80. So some may wonder, how do we get this 80? So remember, if you assume the value of plant as 100, then if the depreciation is 20%, so 100 minus 20% will get 80. 80 here. So to get the actual value before charging depreciation will be 40,000 into 100. This will be the value before charging depreciation, and this will be the value after charging depreciation. So the book value of plant will be 50,000. So similar in the case of furniture. So the book value of furniture as per the balance sheet or 31st 12,015, it was rupees 9,000, and there's a depreciation of 10%. So we have to find out the book value of furniture before charging depreciation, that is as on 1/1/2015. So it will be 9,000 into 100 divided by 90. So how do we get this 90 again? We'll assume that the value of furniture before charging depreciation is 100. Then after charging depreciation of 10%, we'll get 90. So to bring back this amount of 9,000 before charging depreciation will be 9,000 to 100 divided by 90, we'll get 10,000. Then after which we have to calculate the additional or excess depreciation due to increase or decrease in the value of assets. So now let us look at the first one, that is plant. So the revalued figure of plant on the date of acquisition is rupees 60,000. but the book value as on the date of acquisition is 50,000. So it means that there is so it means that there is an increase in the value of plant for rupees 10,000. So if there's an increase in the value of an asset, then additional depreciation has to be calculated. So additional depreciation on increased value of plant will be 10,000 into 20%. You'll get here 2,000. Then similarly, in the case of furniture, the revalued figure of furniture on the date of acquisition is 8,000. But on the date of acquisition, the book value of furniture is 10,000. So there's a decrease in value of furniture for rupees 2,000. So if there's a decrease in value of furniture, then excess depreciation has to be calculated. So excess depreciation on decrease in the value of furniture is 2,000 into 10%. Since the rate of depreciation is 10% of furniture, so we'll get here 200. So point to be noted here. So increase and decrease in the revaluation of assets on the date of acquisition will be adjusted in the capital profit. Increase in value will be added and decrease in value will be subtracted, because increase in value will be a profit, then decrease in value will be a loss. Then the case of additional and excess depreciation will be adjusted in the revenue profit. So additional depreciation will be subtracted, it will decrease the profit, and excess depreciation will be added because it will increase the net profit. So the next working is the control chart here. So first we'll have to find out the pre-acquisition profit or the capital profit. So let me remind you again. In the pre-acquisition profit or capital profit, you have to take the reserve and profit and loss account as on the date of acquisition. These are the two main items. So the profit and loss account on 1/1/2015 as given in the adjustment is 10,000. Then the general reserve according to the balance sheet is 20,000 on the date of acquisition. So the total capital profit before adjustment of the increase or decrease in the value of plant and furniture, it's 30,000. Then you have to add the increase in the value of plant for rupees 10,000. Then you have to less the decrease in the value of furniture for rupees 2,000. So the total capital profit will be 38,000, and this will have to be shared in the ratio of 4:1 between the holding company and the minority holders. So the holding company will get 30,400 and the minority holders will get 7,600. Then the second one is the post acquisition profit or the revenue profit. So here we have to take the profit and loss account for the year itself, and since we don't have any general reserve for the year, so we'll take only the profit and loss account as per the balance sheet is 25,000. So since the opening balance has been given in the adjustment, so to make things simple, if the opening balance of profit and loss account and general reserve is given in the adjustment, it has to be subtracted to find out the actual profit or the actual profit during the year. So according to the balance sheet, the profit and loss account is 25,000. Then you have to less the profit and loss account on 1/1/2015 10,000. So the profit during the year is 15,000. Then you have to add the excess depreciation on furniture for rupees 200. Then you less the additional depreciation on plant for rupees 2,000. So the revenue profit is 13,200. Then will be shared between H Limited and S Limited, where H Limited get 10,560. Then this minority holders get 2,640. Then the next one, you take a share capital of the subsidiary company, it's 50,000. Then you less the minority interest. So the minority holders hold 1,000 shares. So 1,000 shares into 10 rupees. The face value of shares will have 10,000. Then the remaining balance belongs to the holding company. So that's why it has been adjusted in control chart B, the face value of it. Then the minority holders, the total minority holders from control chart will be 20,240. Then let's move on to the next one, the control chart B. So we first of all have to take the cost of investment held. So let me remind you again, this one will get from the asset side, that is non-current investment made by the holding company in the subsidiary company. So according to the balance sheet, it is 60,000. Then you have to less the face value of shares held, that is 4,000 shares at rupees 10 each, that is rupees 40,000. We get this from here, you can take it from here also directly 40,000, or you can write 4,000 shares at 10 each, you'll get 40,000. Then you less the capital profit from the control chart A from here, this one. So we'll get 30,400. So since we're getting a minus sign, so it will be a capital reserve of 10,400. So before preparing the consolidated balance sheet, now let us look at the various note to the balance sheet. So the first one is share capital. This you can easily understand. I think you can get from the problem itself. So the total share authorized, subscribed, and paid up capital of the holding company is 50,000 equity shares of rupees 10 each. So we get there rupees 5 lakhs. Then regarding reserve and surplus, so first of all, we take the general reserve of H Limited from the balance sheet. It's 1 lakh. Then the capital reserve will get from control chart B, that is 10,400. Then the profit and loss account of H Limited, again that we get from the balance sheet, that is 1 lakh. Then you have to add the revenue profit of H Limited, that is a share of H Limited in the revenue profit of the subsidiary company. So this will get from control chart A, which is 10,560. So the total reserve and surplus is 2,20,960. Then the trade payable, this will get from the balance sheet, that is the sundry creditors of H Limited is 50,000 and sundry creditors of S Limited is 5,000. So the total trade payable is 55,000. Then if you look at the tangible assets, so plan of H limited and S limited, that's you will get from the balance sheet will be 3,30,000. Then you add the increase in the value of plan due to the valuation of plan of the subsidiary company, so that is 10,000. Then you have to less additional depreciation, that is the depreciation on the increase in value for rupees 2,000. So the value of plan will be 3,80,000. Then after that, you take the furniture of H limited and S limited from the balance sheet, will be 1,59,000. So since the furniture of S limited has been revalued and you found that there's a decrease in value by rupees 2,000, so you less the decrease in value, then you add the excess depreciation on the decrease in of value of furniture, so 200. So the total value of furniture will be 1,57,200. So in total, the total tangible assets will be 4,95,200. Then in after which you have to do the inventory. So you have to take the stock of H limited and S limited, get 1,50,000. Then a trade receivable of H limited and S limited will be 85,000, and the cash and cash equivalent of H limited and S limited will be 66,000. Now, if you look at the balance sheet, so the equity share capital from node 1 you get 5 lakh, then the reserve and surplus 2,20,960 from the node 2, then minority interest from control chart A, then trade payable is 55,000, so the total will be 7,96,200. Then the tangible assets from node 4, that is 4,75,200. Then inventories from node 5, 1,50,000, and trade receivable 85,000, and cash equivalent from node 7, 66,000. So you'll get 7,96,200. I hope you understand. Thank you.